Right, if you're running your own super fund, you'll know all about that controversial tax on large balances. Well, it's just been completely overhauled. It seems the government has actually listened to the backlash, because the new proposal, it's a world away from the old one. So, what's actually changed? Let's get into it.
This really is the big question on everyone's mind, isn't it? The original plan caused a massive stir, and you know what? For good reason. But the new plan is a huge departure. So today, we're going to walk you through all the key shifts from the old proposal to what's on the table now.
Okay, first up, to really appreciate why these new changes are such a big deal, we need to do a super quick recap of what the government first proposed and exactly why it was so controversial.
So the absolute core of the problem with the original plan was how it was going to calculate your earnings. It was designed to look at the total change in your super balance from one year to the next. And that meant it was taxing unrealized gains. The increase in the value of your assets on paper, even if you hadn't actually sold them.
And believe me, the problems did not stop there. That $3 million threshold wasn't indexed, which basically means inflation would just keep dragging more and more people into the tax net over time. On top of that, if your balance went down 1 year, tough luck, no refund. And there was a real risk of losing those carried forward losses for good. So you can see why the industry pushed back so hard.
So after all that feedback, the government has gone back to the drawing board. Let's take a look at the new plan and see how it stacks up, because honestly, it's a completely different framework.
Okay, the new plan is a massive shift. The tax base is now focused only on future realized earnings, not the total movement of your balance. We've also got 2 indexed thresholds, a new 2-tier tax rate, and the start date has been pushed back a whole year to the 1st of July, 2026.
Right, the most important word on this slide is indexed. By linking that $3 million figure to inflation, it gives you real protection against bracket creep. It means the threshold will actually rise over time, which, let's face it, is a much fairer way to go for long-term retirement planning. And they've also brought in a second, higher tier. For any balances over an indexed $10 million, there's going to be an extra 10% tax on the realized earnings for that amount. So what this does is make the new tax more progressive. It's really targeting those with exceptionally large balances.
Okay, so this whole new system now hinges on this idea of realized earnings. It definitely sounds better than taxing paper profits, but what does it actually mean? And how on earth is it going to be calculated?
Well, according to the Treasury fact sheet, realized earnings will be based on your fund's taxable income. But here's the kicker. It's not going to be strictly defined in the law. Instead, it looks like the calculation will lean really heavily on future guidance from the ATO. So yeah, there's still a bit of a gray area here we need to watch.
So how's this all going to work in practice? Well, the process will kick off with the ATO, who will figure out which members are over the threshold. Then they'll get in touch with your super fund for the earnings data. From there, it's actually up to your fund's trustee to do the maths and report back. That is a pretty big administrative job to put on them.
Now, while this new framework is definitely a step in the right direction, it is far from complete. There are some major question marks still hanging over this whole thing, big questions that are going to have a huge impact on how you plan for the future.
This is probably the biggest question of all. Is there going to be any sort of grandfathering for capital gains that have been building up for years, maybe even decades, before this tax even starts? Because if not, trustees might have to think about selling assets before the start date just to lock in those gains under the old rules. We just don't know yet.
And just to make things interesting, it gets even more complicated. What about gains from assets that are held inside a company or unit trust that your super fund is invested in? For an SMSF trustee trying to figure out the pre-2026 component of a dividend from some unrelated company, well, that's going to be incredibly difficult, if not flat out impossible.
And beyond those 2 huge questions, we're still waiting for clarity on a bunch of other really important details, like how are defined benefit schemes, those old school company guaranteed pensions, how are they going to be treated? And will members with over 10 million be allowed to just withdraw the excess? And you have to wonder, which bits of the original flawed legislation might still find their way into the final cut?
So what's next? Well, we've got a bit of a wait ahead of us. We're not expecting to see the draft legislation with all the nitty-gritty details until early 2026. The tax itself will kick in on July 1st of that year, but you probably won't see the first tax bills actually arrive until late 2027.
So the bottom line is this. We've got a much better framework that avoids taxing your paper profits, which is great news. But the most important details are still missing. The huge question now is whether the final legislation will genuinely protect those gains you've built up over decades, or if it will just create a whole new set of headaches for SMSF members. For now, it's a game of wait and see.